Real estate investment strategies for beginners. Investing in real estate can be a smart method to diversify your portfolio since it produces returns that are comparable to those of the stock market but with less volatility. Aside from the tax advantages specific to residential real estate, investors can increase total returns by using leverage. Although the most popular approach to investing in real estate is directly owning investment properties, there are other alternatives as well for investors to try and profit from real estate. These 10 real estate investing techniques are employed by both novice and experienced investors. There is no one-size-fits-all approach to real estate investing based on your objectives and time horizon. Some tactics will be more effective for you than others. Number 10. Purchase and maintain rental property. Purchasing and owning single-family residences is a real estate investment strategy that can provide rental income, profit from long-term property value appreciation, and qualify for certain tax advantages available to real estate investors. For both novice and experienced investors, single-family homes (SFRs) are likely the most popular real estate investment. As to the latest U.S. single-family rental outlook study published by independent real estate research and consultancy firm Green Street, 35% of all rental units in the nation are SFRs. Almost in the last 20 years, the median sales price of houses sold in the United States has climbed by almost 200%, and there is still a high demand for rental properties. However, due to upkeep, repairs, and possible vacancies, net income from rental property may vary, and some investors might choose a more passive investment approach. Number 9. Reinvest the rental revenue. One complementary tactic used by many buy and hold real estate investors is reinvesting rental revenue. Net cash flow from one rental property is preserved until there are sufficient funds for the down payment on a second rental property, a phenomenon also referred to as the snowball effect. After that, the net cash flow from the two rental properties is saved until a third rental property can be purchased with the remaining funds. Like a snowball rolling down a hill, an investor's cash snowball grows larger and larger as their portfolio of rental properties grows. To pay off a real estate debt more quickly, some owners additionally reinvest their rental income by increasing their mortgage payments. Number 8. Home invasion. One of the disadvantages of real estate investing is the potential need for a sizable down payment. Those who own their home but lack the extra money to buy a rental property use a real estate investing technique known as house hacking. House hacking examples include turning a basement into a studio apartment or renting off a spare bedroom. House hacking rental income is put aside until a down payment on a rental property is sufficient. Another way some investors house hack is by taking out a low down payment loan from the Veterans Affairs VA or Federal Housing Administration FHA to buy a small multifamily property. The requirement that the borrower occupy one of the apartments as their primary residence is one of the method's possible disadvantages. Living next door to tenants is, nevertheless, a great way to learn about real estate investing and obtain practical property management experience. Number 7. Yuck. Using a technique known as buy, remodel, rent, refinance, repeat (BRR), real estate investors can use short-term financing to purchase fixer-upper properties, pay for any necessary renovations, rent the properties to qualified tenants, refinance the properties, and take cash out when the properties have demonstrated a stable history of positive cash flow. The snowball effect and the BRR real estate investing technique are comparable in that both involve an investor taking the same action over and over. Generally speaking, BRR is a preferable approach for an active investor with the time and expertise to handle tasks themselves, or who has a reliable, reasonably priced network of handymen and contractors to assist with renovating. Number 6. Adjusting and rotating. If all goes according to plan, house flipping is a high-risk real estate investing method with the potential for large rewards. Since they only want to occupy a property for a few months, investors who renovate and flip houses don't want to be landlords. A flipper who has found and acquired an undervalued property may choose to hold onto it and attempt to profit from appreciation, or they may choose to strategically renovate the home to raise its worth. Investors who underestimate the cost of renovations or who are unable to sell a property fast may run out of money. Fixing and flipping is therefore best suited for people with a lot of expertise in determining the fair market worth of real estate, the true cost of modifications, and enough funding to complete the project on schedule and under budget. Number 5. Wholesaling real estate. Fixing and flipping is similar to real estate wholesaling investing, but the difference is that a wholesaler never actually owns the property. Rather, a real estate wholesaler looks for a motivated seller who is willing to sell a distressed property. They then put the house under contract at a lower price than the market, estimate the cost of repairs and the final fair market value, and, in exchange for a small wholesale fee, assign the purchase and sale agreement to another investor. Successful real estate wholesaling, like mending and flipping, takes a significant amount of time, market expertise, and strong negotiating abilities to persuade an owner to sell their property for less than the fair market worth. Furthermore, a property wholesaler needs to have a license in a lot of states. For those without a lot of funds to invest, wholesaling real estate could be a wise course of action. To find distressed property, some seasoned real estate wholesalers employ real estate bird dogs who are then compensated with a nominal referral fee. Number 4. IGAs. Small funds known as real estate investment groups, REIGs, buy rental properties in bulk and then let investors purchase properties through the group. The REIT handles all of the marketing, tenant screening, rent collection, property management, and upkeep in exchange for a portion of the monthly rental income. When the residences in the group are sold, investors in a REIG profit from their shares of any recurrent rental revenue and equity growth. For those seeking a more hands-off approach to real estate investing, a REIG might be a viable choice, but it's important to investigate management and their prior record of success or failure. Number 8. REITs. Commercial real estate, residential build-to-rent (BTR) subdivisions, and special-use buildings like data centers and cold storage facilities are just a few of the real estate assets that are invested in by real estate investment trusts, REITs, which can be privately or publicly held businesses. At least 90% of a REIT's profits must be distributed to shareholders as dividends. They can be a useful strategy for diversifying an investment portfolio so that real estate income can be earned without actual property ownership. Generally, credit tenants are leased investment-grade assets owned by a REIT on long-term leases. Compared to other real estate investment options, shares of publicly traded REITs are more liquid since they may be purchased or sold on an exchange. Number 2. Online grants. Crowdfunding refers to digital platforms for real estate investment that allow investors to pool their cash to purchase shares of premium residential and commercial properties, including stabilized commercial real estate, new house developments, and apartment buildings. Purchasing through a crowdfund can be a great way to learn about properties that are out of reach for most people. If a project is lucrative, crowdfunding investors will get pro-rata distributions of net revenue regularly. They will also earn a portion of any profits when the enterprise is sold. The fact that shares are typically illiquid and may be subject to lockup periods until a project is stabilized or during uncertain economic times is one of the disadvantages of crowdfunding. To find lucrative prospects, finance and construct the project, and lease and manage the property to maximize asset value and cash flow, investors must also rely on the experience of the crowdfund sponsor. Number 1. Lending privately. Rather than equity, private lenders engage in real estate debt. Private lenders give money to real estate investors seeking an alternative to conventional financing sources, including house flippers, as opposed to buying rental property themselves. Private lenders get revenue from lending fees and interest rates, just like a regular bank does. On the other hand, costs and interest rates are typically greater. There is a chance that a borrower would default on a private loan, forcing the private lender to reclaim a partially repaired house, even if private lending might be a smart way to earn recurrent interest revenue. Because of this, private lenders are knowledgeable about real estate investing and know how to safeguard themselves if a property needs to be foreclosed. So this is the end of our today's video. Do you like it? Kindly give your valuable response in our comment section below, and don't forget to subscribe to our YouTube channel for more interesting and informative videos.